Welcome to our weekly High Rock video. If you are watching for the first time and are interested in learning more about High Rock, please check out our website at www.highrockcapital.ca. Well, I'm Scott Tomlinson, and normally with me is my partner and colleague and the founder of High Rock, Paul Tepsich. But today Paul is buried in research meetings, so I am on my own. Well, usually we talk about our three models and any updates on trading activity in and around our tactical strategies, but today I'm going to focus a little more on the global economy, its outlook, the implications for financial markets, and our broader investing strategy. Well, today the widely followed International Monetary Fund updated their projections for global economic growth for 2018 and 2019. They do see continued growth led by the US in the developed world and India and China in the developing world. For we Canadians, the prospects look a little less optimistic. Well, as always, expectations of future economic growth come with risks. That these estimates may not necessarily be achieved. From our perspective, this is where we, as portfolio and wealth managers, have to make decisions on how best to get growth into our and our clients' investment portfolios, while at the same time protecting us from the degree of probability that something might go awry. At the moment, the biggest risk to the global economy is trade protectionism. According to the IMF, the prospect of trade restrictions and counter restrictions threatens to undermine confidence and derail global growth prematurely. Now, the thought process around this is the fact that despite strong economic growth on a global scale, it is not flowing through to households, and they are voting for change. In some cases, whether it is the right change or not, and this may jeopardize future economic policy. And as we have discussed in the past on this call, record levels of debt have helped economic growth recover with low interest rates and extraordinarily easy monetary policy, but will take its toll as interest rates rise and return to more normal levels and debt service costs rise. All right, well, looking a little closer at the near term, economic data for the first quarter of 2018 in the U.S. appear to be coming in a little light, as we see that the expectations for GDP growth are looking closer to 2% and below forecast. Now, equity markets, however, appear to be focused on earnings at the moment, and more confident buyers appear ready to test upside selling resistance. After getting reasonably strong buying support at lower points, and we did some buying of equities at these levels ourselves, we were buying with forward-looking price-to-earnings ratios closer to their 5-year averages. Well, bond markets continue to warn us that economies are in their late stages of the cycle, with bond yield relationship between 2-year and 30 years continuing to narrow close to new lows. Historically, recession occurs close to the time when this relationship reaches zero and the yield curve becomes flat. For now, the U.S. yield curve is at about 65 basis points, which is about 10 basis points narrower from when we last looked at this about 3 weeks ago. In Canada, the same relationship at 49 basis points is about 5 basis points wider, which is slightly more positive for the economy. Now, bond markets tend to lead all other financial markets in direction, which means that in all likelihood, most of the good news is built into what we see in the equity markets, and that the bond markets are pointing to some potential for adverse economic developments, be they geopolitical uncertainty or just the fact that the economic cycle has pretty much reached its peak. Now, big and volatile swings in equity and currency markets have usually marked the change in a trend. So from this perspective, with all that we've seen and what the bond markets are telling us, we think it is wise to remain prudent in our strategies as the probability of event risk remains elevated. Now, of course, one of our prudent strategies has been to use the non-correlated asset class of Canadian high-yield bonds, which has had the best risk-adjusted returns over the last 5 years. Non-correlated meaning that it is not impacted by either the change in interest rates or what stock markets are doing. And means as long as we do our research on the company who is issuing the bonds and we manage the default risk appropriately, it is an excellent way to lower risk and continue to get growth. You can check out my blog on this topic that I wrote yesterday. It's on our website under Scott's blogs. Well, that's it for this week. Paul hopefully will be back next week and we will have another discussion on what is driving our investment decision making at that time. But in the meantime, if you have any questions, feedback, please feel free to get in touch. But until next week, I hope you have a great rest of the week.